You're listening to Pre-Market Prep. I'm Brianna Valesky here with Joel Elkann, and we have Sean Udall on the line. He's a tech stock strategist. He is the CIO of Quantum Trading Strategies, as well as the author of the TechStrat report. Sean has more than 20 years of experience working for some of the biggest firms in the country, Morgan Stanley, Salomon Smith Barney, managing over $350 million in client assets, and writing prolific content on the tech sector. Thanks, Sean. It's always a pleasure to have you with us. Thanks for joining us today.
Hey, thank you. It's always good to be here.
So you mentioned that you were watching some stocks that have been hammered lately that may not be on a lot of other people's radars. Do you want to elaborate a little bit on that for us?
Yeah, sure. So, I mean, there's some of these names that I've talked about before on the show. In fact, CyberArk is a name that I've talked about on the show at much lower prices, and it was quite a bit higher. But that's something, I'm looking at again. In fact, I bought some yesterday. But things that people maybe don't think about are some smaller big data plays. I think a lot of people probably know about a company like Splunk, but there's two smaller companies. One is called New Relic, NEWR, and the other one is Hortonworks, HDP. And so, these are the kind of names that sort of whenever there's a big sell-off in the market, especially when sort of high beta is selling off, even if it has nothing, well, it's especially great if it has nothing to do with Greece or China or anything like that, right? So a lot of times when the market's just getting hit, other stocks will get hit 2 or 3 or 4 times the amount the market gets hit. So those are two names I like. Micron, in fact, Joel and I were kind of talking yesterday ourselves. Everybody loved Micron at, I don't know, 24, 26, $30, whatever the highs were, 36. And, now the stock's under 20 and it doesn't get mentioned, and nobody, everybody, I guess, hates it now. The people that were buying it at 30 hated it at 18. So, stuff like that. I mean, there's just, effectively what's happened out there, and I'll cut this short because you probably have some questions for me, but whether people want to admit it or not, I actually think we've been in a stealth bear market for probably the better part of a quarter or more. So you have a situation where the stock markets haven't put in official corrections, although China has, and Greece certainly has, and maybe some parts of Europe have, but the U.S. hasn't. But that doesn't really matter, because when you have 72% of all stocks, this is all listed stocks, trading under their 50-day moving averages, and you have something like 55 to 60% of stocks trading under their 200-day moving averages, you have a heck of a lot of companies that have corrected 20% or more, right? Well, let's say 15% for sure, and a lot of them 20. So I think, we've basically been in the stealth bear market around probably since the peak of March. And now we're sort of digesting it and get that through. But I mean, at this point, if something's down 25, 30, 35, 40, 50%, and it's a really good company, it has a really good balance sheet, and you think the earnings profile is good long term, I think those are the names you better be looking at, because that's the stuff I'm looking at.
Sean, I'm a newer investor, so can you help me understand what you mean by stealth bear market?
Yeah, I mean, it's as simply said as if you start adding up a lot of the companies underneath the surface of the market, and thinking about how many of those companies are in their own bear market, meaning more than a 10 to a 20% correction or more, right? So if you start thinking about that, it doesn't really matter if the S&P 500 has had an official correction of 10%. An official bear market, is 20% or greater correction. But to me, I don't need the S&P to go down to 12.67% to give me the go sign to buy a stock that's down 40%, right? If I'm looking at a stock and I like it and it's down 40%, and this is just an example, I don't need the S&P to tell me, oh, ding, 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 I just went down 50%, so go ahead and buy what you want to buy, right? If I like something, I don't necessarily need to wait for a certain market downturn to kind of give me the green light to buy something. So, what I do works for me. I think it has worked for a lot of other people who've been reading my work for a number of years, but it doesn't work for everybody. I mean, if you're a momentum trader and you just can't tolerate buying anything unless it's at the top of the 52-week high list, then that's what you should do if you think that's the right thing to do. But Yeah, simply put, a stealth bear market to me just means that maybe the markets haven't put in an official correction, but plenty of stocks have. So don't be afraid, to do your own work and find stuff you like, and then when you think the time is right, either buy or sell it.
That's a great point. So how do you play a stock like Micron here? I mean, are you just gonna would you start to nibble or will you go all in? What would your strategy be?
Yeah, I never go all in. I mean, so I have started to nibble a little, but right now what I kind of do each day, in fact, each day for the last like probably week to 2 weeks, I just kind of feel like my buy list keeps increasing. So I'm not really putting a whole lot more assets out there, and not really firing at a whole lot more names yet. But I just kind of keep increasing the amount of names that are interesting to buy. So sometimes the best thing to do is really to not do anything and then to wait and just see how kind of crazy people get, see how deep these corrections get. But certainly Micron at 18, below 18, I mean, there's certain names that are, again, CyberArk, I'm not sure why, but I had kind of picked 55 or below yesterday. I'm like, if the stock goes to 55 or below, I'm going to buy some. And that's exactly what I did. It ended up going to 53. I didn't catch any at the lows. But I was willing to buy some of that. Alibaba, kind of the same thing. I've been watching that for a long time. You maybe were going to ask me about that anyway. But there again, I kind of had a $77 price in mind, and I'm like, okay, I can kind of nibble a little bit. So right now, it's more sort of cautious nibbling, cautious partial buys. And then again, expanding my list of names that I'm willing to go after. Another one that this is a little more known, but it's still a mid cap stock, is a ServiceNow. That's what I missed yesterday. That's one on my list that kind of said, hey, anything around 73, 74, I'm willing to do it. But part of the problem was when things start going haywire, and you have the Dow that goes from kind of muted in the morning to Dow, I don't know, minus 200, minus 250. Basically what happens, everything goes down at the same time. So, sometimes it's just sort of physically impossible to look at every name that you like at every price point that you sort of identified as a good one. But that one, again, at 73 or below, I like it. That actually was in the mid 72s yesterday, but I missed it.
What
So
stock is that,
what
Sean? What stock was that?
ServiceNow, NOW.
Oh, okay. All right.
Yep. So really what's happening to me is my buy list is just expanding every day. So I'm just finding more names I'm willing to commit capital to, and I don't need to get them all. I just need to get a few of them, and ideally I get the ones I like the best. But sometimes you kind of have to be able to go after stocks you don't like the best. Sometimes the stuff that will actually go up the most are names that sort of are, for whatever reason, they're not liked as much. So it's sort of like the second, third tier names sometimes will give you the best returns in a market like this, because if stuff is just sort of selling off and going down for effectively no reason, then, again, sometimes the most beaten up stuff will keep going down and get even more beaten up. So, again, you gotta find what works for you. But yeah, basically the modus operandi is just sort of increasing my buy list every day, and then sort of seeing, okay, what is the stuff out there that's been beaten up the most? A name like Intel, I'm just looking at right now. Same thing, everybody liked it 10 points higher, 6 to 10 points higher. Now the stock is under 30. Everybody hates it. Everybody thinks the Windows cycle is going to be bad. Personally, I think the Windows cycle is going to be just like the last 3 or 4 Windows cycles. They're always kind of the same. But this stock under $30 is pretty compelling to me. So again, does it get crazy? Does it go to 26 or 27 or 28? That would be beautiful. But I'm willing to maybe buy it here. But there's nothing wrong with waiting to see if there's a little bit of a reversal, just like we had yesterday. So right now I kind of want to wait, see how ugly things get, and then maybe try to catch some of the things as they come off the what I call the first price flip.
Sean, I've got a question coming from one of our chat room guys. Rob Hood is saying individual stocks have corrected 20%, but indexes haven't. Do you think that's coming?
Well, I'm not sure, but he kind of speaks to my point, kind of my stealth bear market, right? The average stock might be down roughly 20% already, which is kind of what I think. or the statistics back it up, yet the stock market hasn't. I don't know. Sometimes the averages come down to meet the average stock. Other times they don't really do that. I mean, pretty much since the last correction we had that was close to 20% was 2011. So I actually think it's harder. I think if the more stocks you get down 20% or more, that means a lot of damage under the surface has already been done. So theoretically, the more stocks that are already down, the harder it is to bring the market averages down, just because you already have a lot of stuff that's down. The question is, do stocks that are already pretty cheap, Google the averages are made up of basically the 20 largest stocks comprise a huge percent of the averages. So, for example, if you're looking at the NASDAQ 100, my math might be a little off here, but I think if you look at the top 15 to 20 names, you kind of have 55 to 60% of the NASDAQ 100, if not more. I mean, Apple alone is like 15 to 17% of the NASDAQ 100.
Right.
So then you start stacking up, your 10 next names next to Apple, you definitely get to 30, 40, 50%. Anyway, the question is, does an Apple that's already selling at a big discount to the S&P 500, does that drop another 5 or 10%? You talk about a Google, which is a big weight in the NASDAQ. Google's already beaten the tar. They're probably already down 20% or more from highs. Do they need to drop another 10? So anyway, you start looking at what is already beaten up that has a large market cap. I think what's different this time is you already have Intel, Apple, and Google. Well, Apple hasn't had a big correction, but it's really cheap. It's selling at a big discount to the market, which, again, we've talked about how stupid that is. So then, do stocks that are already 10 or 15 or 20% down go down more to pull the averages down? I don't know. We'll see. You don't have to have the averages officially put in a correction. Obviously, we're seeing it. We have plenty of stocks down 20% or more. So, yeah, the averages don't have to go down to meet it, but they can.
You mentioned that you were getting slightly interested in Alibaba. Does what's happening with the Chinese stock markets right now and their overall financial system kind of concern you at all for any of these ADRs that are based in China?
Not really, because, if you kind of look at Alibaba, what's interesting, it never participated at all in sort of the whole crazy move that the Chinese market had. So in other words, the whole time that the China market was going from whatever level it was to up 50 or 100%, and it depends because you have this wide dispersion of Chinese markets, right? You have the top 50, which was never really up that much. Like the FXI is the ADR for China, the top 50 stocks in China. It's literally only up 5% over the last 5 years. But then you have like 3 or 4. You have the China A shares, which I think they were up. Joel might even be able to. I think they were up about 100% off the lows. But then you have other indices, which is like the small cap and their tech indices, which were up crazy amounts, 150, 200% or more. So, but Alibaba, the whole time that China market was exploding higher, what was Alibaba doing? It was going from like 108 to 82. So, maybe Alibaba was more reflective of what actually is kind of going on over there than those Chinese markets are. So the fact is, if Alibaba, sure, I'd be concerned if Alibaba, if it had gone from 82 to 140. In fact, I'd be short the name above 125, 130. But the fact is, Alibaba never participated in the whole Chinese run. So, by the way, I have zero idea why. It just didn't. So no, the fact that it's basically, it's probably the same thing as Alibaba itself is probably selling at a way, way cheaper valuation than the average Chinese stock. So we'll see what happens. But no, I'm not really concerned about Alibaba, other than it might take longer. It might take longer for the name to get, to where I think it's going to go. Meaning, to get back to 100, to get a really good juicy 20, 30% return out of it. The longer this Chinese issue kind of hangs around, the longer it might take Alibaba to have an upside ripper.
Hey, that's a great point, just seeing if it's even correlated with the moves in the Chinese stock market right now. I would love to turn our attention to a recent IPO, Fitbit, and get, if you've been watching this at all, your fundamental take on this. one of the things that we always bring up when we talk about this stock is like, I mean, what do they have that no one else has? Yes, they have a smartwatch, but so does Apple, so does all these other companies. I think Nike has a smartwatch, and they don't seem to have any proprietary technology, but people are really loving this issue. What's your take on Fitbit?
Yeah, I think Fitbit will probably end up looking a lot like, well, in fact, a lot like the GoPro IPO did, maybe a minor version of the Shake Shack IPO, meaning that the IPO comes out. It does have a bigger float count, meaning the amount of shares outstanding is larger than some of these other IPOs that have been out. But I think that the gravitational pull of Fitbit will probably be to a higher stock price until you get fairly close to the IPO lockup, which is 6 months after the issuance of the stock. So, that was the thing that hammered Twitter. Twitter's first great big decline was on its IPO lockup.
Ooh, Twitter just
GoPro
took a
got
big, hey, Twitter just took a nice jump there,
Sure.
Sean, up 44 cents here, coming up into 36. I don't know if there's any news coming
Sure.
across the wire here, but me and you have been going back and
Yeah.
forth on Twitter here. You're still sticking with your bullish thesis there, buddy.
Yeah, in fact, I like that. That's another one I kind of nibbled on a little. If Twitter's down close to $1, there's no guarantee I'm out there buying it, but generally I am. And by the way, I'll just mention this before going back to Fitbit. Twitter has been actually they have shown relative. Now it kind of makes sense they would, because they're down 32, 33% from highs. The market's only down 5%. Twitter's already had its massive correction, right? Whether it's deserved or not, it's had it. But yeah, what's been happening is they've been showing pretty good relative strength the last couple of weeks. Even days that are really bloody ugly in the market. But some of those days, Twitter's basically finished flat, even though the Nasdaq's been horrid. So yeah, I mean, I think it's fine. I think it's going to go up. I think we're going to have to wait 2 quarters or more to really, really get paid on it. But maybe what's going to happen with Twitter is, what if Google starts talking about the fact that their relationship, that they just did the search deal with Twitter about 6 weeks ago now. What if some news starts coming out where they say, hey, having Twitter data is really starting to show up in the search rankings. It wouldn't take much for people to go, oh, wow, that was a really good deal. That Google Twitter search deal is a major thing that, lo and behold, we've all sort of forgotten. So we'll see what happens. I don't know. I don't know why the stock's up. It has been showing relative strength lately, even on days where there's not some stupid M&A rumor on it too. But anyway, so back to Fitbit. I think Fitbit probably has a gravitational pull higher until you get probably 3 to 4 to 6 weeks from their IPO lockup. Then I think it probably becomes a pretty dangerous stock, depending on how high it is. As far as like the company, I kind of look at Fitbit right now a little bit like how I looked at iOS versus Android a couple of years ago. So what you had was, you have Apple with the watch and some other products selling much higher priced products. Fitbit is coming into the market with a much simpler device that sells at a much lower cost. So in the early, sort of in any tech cycle, there's always a lot of impetus for people to go out and try cheap products, especially if there's some novelty to them. And Fitbit does have some originality, even though there's a number of companies that do what they do. But I think that's what's happening. I think there's a lot of people who are interested in this wearable and fitness space. So they're going out and looking at, okay, maybe I don't want to pay $500, or maybe I don't want to pay $350, but I'll pay $99. So I think Fitbit's kind of grabbing a lot of that interest, if you will, at the low price point. My thesis longer term is I think they could be pretty challenged, because I kind of think the Apple Health Kit and Apple Health technology and the more robust nature of the Apple Watch will sort of win the war over time. Just like high-priced Apple iOS phones have won the war over time versus a lot of the lower-priced Android phones. But I think Fitbit could be a decent company and have really strong growth for, a number of years. And it may not be disrupted by Apple. GoPro has done very well as far as issuing results. The stock has been hit, but the stock has made a very, very nice recovery. And GoPro has managed to compete just fine against the Apples and everybody else of the world. So Fitbit might be able to compete. I like the stock for a few more months, and then around the time of the IPO lockup, I'm going to be completely out of it or even net short the name.
Sean, we've only got a couple minutes left with you, so we have a question coming out of the chat asking for your thoughts on semiconductors.
Well, I hated semiconductors. I mean, in fact, I wrote many notes saying that I thought people were lunatics if they were still buying Skyworks and Avago and Qorvo and, you know, some of the high-flying semiconductor stocks that had gone up 3- and 4-fold, not unlike the Chinese market has done recently. So at this point now, what is the stock? I think the stocks had dropped a cool 100 points off the high. So it had gone from 750 to 650 intraday yesterday. I don't have the stocks in front of me right now, but the bottom line is I definitely like the semiconductor index a lot better, 100 points lower. I still don't love it, but I do. You know, names like Cypress Semiconductor. We talked about Intel already. I like. There's a few names I do like. I've been writing about. InvenSense is another semiconductor. It's really a gyroscope maker, but it's in the semiconductor space. So anyway, the bottom line, if it's a cheap, beaten the car hated semi, I'm probably starting to look at it. If it's still Avago, Skyworks, like NXPI, the most loved semis, which by the way, I had almost every one of those names 1 or 2 or 3 years ago. I sold them all off between anywhere from late 2013 to mid 2014. So those particular names would have to come down a lot before I would get interested in them. But yeah, I like the cheap beaten up semis. Cree is another. In fact, Cree, I own some Cree. That's CREE. So anyway, to me, it's kind of a barbell now. You have semis that are very, very expensive, but you have a lot of semis that were already cheap that have now gone down another 15% or more, and those I like.
We've been on the line with Sean Udall. He's a tech stock strategist. He is the author of the TechStrat report. He is the CIO of Quantum Trading Strategies. He can talk about any tech stock you think of. Sean, it's always a pleasure to have you joining us on this show. We really appreciate your insight, and we'll have to have you back on very soon.
Take care, guys. Happy trading.